Welcome to PhillipCapital Weekly Market Watch. My name is Victor Y from Unit Trust Research. In this week's market commentary, we are going to look at the possibility of taking on higher risk by investing in emerging markets with the prospect of gaining higher returns. The World Bank slashed its 2013 global growth forecast to 2.4% from its June forecast of 3%. Fiscal resolution reached on New Year's Day is estimated to shed 1% of US GDP from the already weak US growth of about 2%, while leading indicators in the Eurozone hints at a still contracting Eurozone. 4 years after the onset of the global financial crisis, the world economy continues to struggle. For 2012, Deutsche Bank estimated that the world probably expanded at only 2.9%. Developing economies, in particular BRIC, are still the main drivers of global growth, as their respective GDP are above the world's GDP. Hence, we look at the global emerging markets, where real returns can be found after netting off inflation. Broadly speaking, there are two tiers of emerging markets: the BRIC and the MIST. First tier BRIC stands for Brazil, Russia, India and China, while the second tier MIST stands for Mexico, Indonesia, South Korea and Turkey. These economic powerhouses share common attributes, such as fairly stable economic climate for investors and an aspiration to graduate to developed economies. Brazilian economy is likely to expand at a tame rate after an avalanche of lax expansionary policies in 2012. According to President Rousseff, Brazil will reap what it sows in 2013 and 14 as the country prepares to host the World Cup 2014. Additionally, as long as China continues its demand for raw materials, Brazil is likely to expand its trade surplus. Key risk to its trade is the weakening US dollar, which makes Brazilian exports expensive for the US consumers. Now, R for Russia. Advanced estimates by Russia's Economic Development Ministry praised the country's 2012 growth at 3.5%, with unemployment rate at only 5.4%. Despite softening macro outlook, the world's largest oil and gas producing country continues to expand, with investments lending strength to overall GDP growth. Being the world's most democratic nation, it is not easy for India to pass structural reforms and initiatives. When it did so in the supermarket reform, effectively allowing mega marts like Walmart to tap into the once elusive mass retail industry, it is more a sign of the country's willingness to liberalize. On the macro front, India's inflation cooled in December 2012, brightening hope for a further rate cut to mitigate the sluggish global demand. For 2012, India's GDP is likely to be in the range of 5.3% to 5.8%, which nearly doubles that of the world's GDP at 2.9% forecasted by Deutsche Bank. No discussion of emerging economies is complete without mentioning China and its policy impacts on global economy. At 7.5% estimated growth, there is insufficient evidence pointing to a hard landing in China. In fact, indicators are signaling a stabilizing economy which may have bottomed out. Chinese manufacturers enjoyed a strong end to 2012, with operating conditions improving at the fastest rate in 19 months, according to HSBC compiled December PMI data. Inflation is stable at close to 3%, despite cheap money flowing out of other major developed economies. China's trade surplus expectedly narrowed last month as the country continues with its structural and economic reforms. Taking a medium to long-term investment approach, we are confident on the Chinese economy. Following the fiscal cliff resolution, global investors have entered 2013 in buoyant but not yet exuberant mode. For cautious investors who wish to add emerging markets exposure to their portfolio, you may consider the following funds. The highlighted portions show the best fund in each column. Of the better performing equity funds, we prefer First State Global Emerging Markets Leaders Fund, as it has superior risk-adjusted Sharpe ratios. Moreover, over a 3-year period, it has an annualized return of 8% while minimizing downside risk with 13.7% maximum drawdown. With the same standards, we are able to pick a better performing emerging markets bond fund. PIMCO Emerging Markets Bond Fund has higher risk-adjusted Sharpe ratios for 1-year and 3-year periods. The $8 billion US fund is managed by two fund managers with 31 years of experience between them. All the funds mentioned here have diversification theme in mind. Of course, diversification does not guarantee a profit or protect against loss. Before you invest, please consider your risk profile and investment constraints. In conclusion, we advocate constructing a diversified portfolio to ride out the global volatility as the US once again negotiates to raise the debt ceiling. To quote Winston Churchill, you can always count on Americans to do the right thing after they have tried everything else. With that, happy investing. Thank you.